Mark Lackey joins us, CHF Capital Markets. And Mark, great to see you.
Good to be back, Pat.
You know, how long ago was it that we talked about gold? And I think you were bang on with your gold prediction at that time.
Yeah, pretty much, Pat. If we go back about 3 months ago, we really thought gold was going to trade in this 1,200 to 1,300 range. But I did think, Pat, that by the end of the year we'd get to 1,300. We were looking right now that unless I get a $70 move in the next 2 weeks,
you're not going to get that.
It's not looking like it. In fact, you know, I'm just looking at the fact that now you got a lot of analysts, big divergence in the gold price. I would say the biggest divergence I've seen since really the late 70s. So you've got people saying 1,000 next year, other people saying 2,000. I'm going to say I'm going to end the year at around 1,400. So I've got some upward movement.
And next year.
And then 1,600 at the end of 2015. So I see some upward movement. I'm not in the big bullish camp, but I'm not in the camp of, say, the big U.S. banks who see $1,000 for really the next 2 or 3 years.
Because they're predicating that on a position on the U.S. dollar, not necessarily. And gold is a competing currency per se.
It is, Pat. And I think there's a few other things that they're different than me on. I think they believe that maybe the ETF market, which is the ETF gold market, has really sold a lot of gold into the market. I think that's going to start to now dry up. Because after all, they're running an ETF for gold. I mean, they're not putting many other things in there. So at some point, they're going to redeploy that cash when they feel gold's at least at the bottom and has a chance to recover. And the second thing is we saw this weekend that the Indian government has actually started to reduce that import tariff, which had a negative impact on the demand for gold in India. As you know, they put up a fairly significant tariff. We talked about that the last time I was on,
that's
Pat.
right.
And now that their current account deficit's gotten way better in India, they're now not so concerned about importing gold. And they want to keep their jewelry business going.
Because importing gold means currency going out.
Absolutely. And that was the problem, because they had a pretty big current account deficit, but it's amazing how much they've shrunk it in literally a year. So as a consequence, they now have a different view. So I think between good jewelry demand that will take place in China in the next 2 years, and I also have said before, Pat, I think that the long-run bond purchasing in the U.S. will end, and money will flow out of the long end of the market, and some of it will flow towards commodities. A lot of it will go to the short end of the market in the bond market, fine. But you know from your days in the street how big the bond market is.
Yeah.
I still think we're going to see some movement into gold from the long end of the bond market over the next 2 years.
Isn't the key driver to all of this is what central banks are doing? Are they holding on to gold or are they selling it?
Right now, recently, there's actually been some small net buying, believe it or not. So
out of China or someplace
right,
like that?
Largely. And what the Europeans haven't been doing much. So you're right, there hasn't been a whole lot of central bank buying, but there hasn't been a lot of central banks selling, because down at these prices, a lot of the central banks feel that this is not where they should sell gold. They feel that price has gone down more than maybe they anticipated, so they don't want to sell at what they think is the bottom of the market. So I do think, Pat, there's a lot of issues when you look at gold. The difficulty, of course, is there's so many more issues with gold than there are copper or zinc or the base metals. They're far more driven by demand factors you can look at quite easily. It's much more difficult to have a handle on gold given all the demand issues that are
Okay, so you're not a super wild bull on gold,
no.
but you're positive on gold. So
That's
how
right.
do you play that?
Yeah. Well, Pat, you'll note today people have said to me, boy, there are like 500 gold mining companies. There's so many. Yeah. I said, well, I try to distinguish among the ones I like for all kinds of reasons. And today I'm actually even mentioning a big cap, because people said to me, what's your favorite big cap? I like Inigo Eagle. I think that when you look at Inigo Eagle, they have had, quite frankly, very few missteps. They've got a very good management team. They continue to pay an increasing dividend. Production has been rising. And so they've got all the positives that you want in a big cap gold mining company. Sure, their stock prices got hit like everyone else because the price of gold's down $600 in the last year. But I think that in a better and rising gold market, even one like mine that's relatively a modest increase, there's a good opportunity for people to realize that this is an undervalued stock, because I would argue it's trading like the price of gold is around $1,000 an ounce.
Right.
And so
what is their cost of production right now?
Well, I think that, they have a number of different mines. I'd have to, the overall cost I don't have actually in front of me, but I believe it's well under in the $600 or $700 range. But again,
okay, so
you have to
even
look at all
if
the
it gets down to
mines.
1,000, you're still...
Yeah, I mean, these guys are not, I'm not, the three people I'm looking at today, I think all survive quite nicely in this environment. Now, admittedly, to get lift on the stock, you want, obviously, gold prices to go at least somewhat higher.
Yeah, and that's on the assumption that they are leveraged into gold prices. Right. We've seen disconnects between the stocks and the underlying commodity.
No, in fact, I would argue there is a disconnect right now, because, again, I think Inigo Eagle should be trading at least 15 to 20% higher given the price of gold where it is today. The disconnect all seems to be that equities tend to be underperforming the metal. Now, that may be because a lot of people who are in the equity market think the metal is going to get weaker. So if we look at the second one, Primero, same thing. They just bought Brigus the other day. So this combination is to me an outstanding mid-cap play. And again, the stock's trading as if the price of gold is going to go down another $200. Now, it's possible. We don't think it's going to breach 1,200, but obviously in the next few months we'll see. But I think what I like about this company was they have a Mexican play where they have production, and now they're adding a Northern Ontario production. So they're going to be about 250,000 ounces by the end of next year. That's a pretty good size for a mid-cap player. And I think it will get on the radar screens of bigger companies down the road.
Yeah, so it's a takeover candidate.
It probably is, and I'm sure they don't want to really be taken out at this stage,
right,
because like everyone else, their stock price could certainly appreciate in a better gold market. But takeouts tend to occur largely in rising markets, not down markets. So I thought it was a good move when they bought Brigus the other day.
Okay, and what's your third pick?
Well, Premier Gold's one that we like because this is a near-term producer. They're in Northern Ontario and also in Nevada. Ewan Downey, who runs this company, once ran Wolfton, which was a huge takeover for all the people that were involved in that. And I think he's got a near-term producer, which should be a relatively low-cost mine, particularly in the Northern Ontario aspect. And so, again, I think it's one that people should be looking at in order to leverage themselves. The stock has really been hit very hard, especially with tax loss selling. That's occurring.
Yeah,
right at the
tis the
moment.
season. And are you seeing a lot of that in the gold share? Is this a situation where you should wait a week or two just to see how it all flushes out?
It's not a bad idea, Pat, because the last tax loss selling day will probably basically be December 24th. Now, some people have already done it, but it's not a bad idea to at least recognize that you could see some more downside weakness here in the next week, given that this is the biggest tax loss selling I've seen in a while, because remember, a lot of people have made a lot of money on the banks, the utilities, NASDAQ. There's a lot of gains out there. So the losses tend to be in the commodity area.
Yeah. Then you're free reign come January.
That's right.
And, of course, are we going to see you next week?
Well, I'm available, Pat. If you guys have a show on the 24th, I'll be here.
Okay. I actually don't know whether we do or not. Mark Lackey. If not, have a great Christmas.
Okay, same to you, Pat.
Executive VP of CHF Capital Markets. We're going to take a quick break. When we come back, we're going to have a spokesperson for the National Firearms Association joining us.